Hello and welcome to our discussion on accounting. The focus of our today's discussion is deferred tax liabilities, deferred tax assets, and the financial statements. Whenever you open any financial statements of any company, you see this DT, DTL and DTA. Let us see some companies. Let's say Hindustan Unilever, an Indian company. If you see in the profit and loss account, there is a deferred tax item on the income statement. Similarly, on the balance sheet, you have deferred tax asset net. So what is this deferred tax which is visible on the balance sheet as well as the income statement? It's not just a case of one company. If you pick up another IT company, Infosys, there also you can see the deferred tax asset. So what is this deferred tax? What is the impact of the deferred tax on the financial statement? Is this just limited to some Indian companies? The answer is no. Let us see Singtel, which is a Singapore-based telephone companies, telecommunications. And if you go to their financials and see their statement of financial position, and we can definitely see the deferred tax assets on the balance sheet, and also maybe deferred tax liabilities. Some companies show separately deferred tax assets and deferred tax liabilities. Some companies show the net of deferred tax on the balance sheet, and some companies show very explicitly in the income statement and also on the balance sheet. So conceptually, there is a need for us to understand what is this deferred tax. Deferred tax is actually the tax on the timing difference or the tax on the temporary difference. This arises due to deferred tax is a tax on the timing difference or the temporary difference. It arises due to the difference in the income statement profit and the tax statement profit. The income statement profit is prepared as per the generally accepted accounting principle, where the tax statement or tax is calculated as per the principles given in the Income Tax Act. Let us take some example. Let us see these transactions. We'll convert these transactions into financial statements and then observe the deferred tax. With this opening balance sheet, we are going to see the transactions. So the opening cash in hand, 2 lakh, sold 50% of the stock, so sales is 200,000, and the sales is for cash, and the received dividend is an income, and dividend is a cash flow. We are preparing the accounting financial statements. Purchase plant for cash, where purchase is an acquisition of an asset, so plant will appear on the balance sheet as asset. Depreciation on the plant 25% for accounting, depreciation for the plant 25% for accounting, 0.25. So as a result, the plant value will come down. Forgot to mention, whenever there is a sale, there has to be cost of goods sold. The cost of goods sold is 0.50. So the stock will come down to the extent of the goods sold. The operating expenses for the period is 10,000, and we pay that operating expense, otherwise would have created a liability. And interest for the period is 8% on the loan, So 6,000. Here also we assume that interest is paid in the current year. So since all the items, incomes and the expenses are been taken care, the summation of expenses will give us the profit before tax. But in order to find the tax, it is necessary to see the tax statement, and in the tax statement it says, for the purpose of taxation, the depreciation is 100% and the dividend is exempted. So sales is a taxable income. There is no dividend. Dividend will not be included in the taxable income calculation. COGS same as accounting. OPEX same as accounting. Depreciation is entire 50,000 is allowed as the deduction, which is in some countries called capital allowance. Interest same as accounting. So the total expenses for taxation is 98,000. The COGS is okay. So therefore taxable profit is 98,000, 200,000 minus 98,000, assuming the tax rate to be 30%, 0.30. Okay, so the current tax is 30,600. It is mentioned that we did not pay the tax, so no cash flow, but tax payable will become a liability, 30,000 minus 0. And deferred tax, the deferred tax in this case comes because of the timing difference. The timing difference on the depreciation. So therefore the timing difference is because of depreciation, 50,000 minus 12,500. So the depreciation leads to the deferred tax here, 50,000 minus 12,500, whereas this is called permanent difference. The deferred tax is not charged on that permanent difference. So the profit for taxation is not same as the profit for accounting because of the dividend and because of depreciation. But the dividend is a permanent difference and depreciation is a temporary difference. So deferred tax is not paid, so deferred tax will appear as a liability on the balance sheet. So profit after tax is equal to PBT minus CT and minus DT, and CT is the current tax which is calculated as per the tax statement. DT is the deferred tax which is calculated as the difference between accounting profit and tax profit arising due to the timing differences. Since no information is given, we will transfer the entire profit to the reserves. Now we can find the cash in hand. The cash in hand is equal to the cash available minus the cash payments, and the cash available is 420,000. So cash in hand is equal to 354,000. All the transactions done, no change in the capital during the period, no change in the loans, no change in the creditor. So the total sources is 898,500. No change in the shares, no change in the debtors, no change in the R&D. So the total of sources should be equal to assets, which has happened here. So we can see the deferred tax liability. Deferred tax liability has come because there is a deferred tax, and deferred tax is there because of the timing difference, So the deferred tax liability, which is shown on the balance sheet, has to be shown as a separate item instead of adding with equity or debt. But if you see the tax payable, suppose this business is closed now, and if we say that there has to be, the assets will be sold and the money available will be paid off, then you have to pay off the creditors, you have to pay off the loans, you have to pay this tax payable as a statutory liability, but DTL is not a statutory or a contractual obligation. Thank you very much.